Welcome back, everyone. Beautiful Friday here in Florida. I've thoroughly enjoyed the markets this week. Doesn't matter what's happening. The life of a trend follower, so much fun. Um, so today I think we're going to have Andrew join us. This will be his first time on Spaces, so maybe it'll take him a while to figure out how it all works and how to get on, but I'm pretty sure he will join us at some point. And we can spend more time talking about his fund and the success and the AUM and the performance. What a great story it is, and it's becoming in a magical 2022 for trend followers and for replicators. Okay, thank you, Matthew. Yes, that's on my list. It's number one on my list to thank Matthew for making all of this happen. All he had to do, all I had to do was what he did, and I didn't do it. So you did it. Thank you. We appreciate it. We spent an hour and 45 minutes talking about Andrew and his fund last week. So we'll get some more time. And so get your questions ready for him. Maybe. I don't know. He'll make a grand entrance, hopefully. Okay, so as tradition, we always start with Oleg, and I hope he has his technology ready. And if you want to speak and ask a question as we progress, just raise your hand. And it's hard to find people in Spaces sometimes, not as easy as Clubhouse. Okay, hello, Oleg, how are you?
Hi, Jerry. Hi, Niels. Hi, everyone. Hi, Bruno. Hi, Matthew. There's a lot of wonderful. Hi, Jerry Smith. A lot of wonderful guys, a lot of wonderful traders here. And so I want to say that, of course, I'm very happy. Maybe only because of the moment I'm here, it's the very big reason to be happy. So, of course, it's so, and it's always, I think, be so, and it was so always. And it's for a trend follower, it's we can make a happy life to ourselves with only trend following mindset. And because we do a lot of things that do a lot of that, it's a mindset of a successful person, trend follower mindset of trend follower, because we ignore the noise, focus on the main things for us. And that main things, which is very important, that main things, they are proved, I think, by centuries. So it's really main things, and we focus on that. And so, of course, I have a good mood when I see that market moves. But I remind myself when market don't move, I remind myself that I must have a good mood even in this situation, because I'm focusing, because I'm doing my job. And I think it's the main thing here to control our emotions on this side. And it's all this is very important, and philosophy, mindset teach us a lot of things that are very useful in our life, in our ordinary life, I think, in our daily routine.
All right. So he's trying to get into the room. I need to spend maybe I'll spend a couple minutes getting him to helping him do that. But in the meantime, I'm going to invite some other people up to talk and keep it going. Niels had a really good podcast with Andrew a few weeks ago, and some of those, I think a couple of Niels's questions get answered. So I'm looking forward to asking Andrew more about commodities, and if he gets on here, we'll see.
Hi, Jerry. Hey, everyone. I very much enjoyed your spaces last week. Fun conversation trying to figure out if indeed replication is the next way of doing trend following, or whether there are some weaknesses. So it'll be fantastic if Andrew joins us. I've certainly been thinking about it, and I do think there are some key differences that I think Absolute and maybe Rich was trying to get to last week. So yeah, hoping he'll be joining, and so that we can ask him some more questions.
Morning, everyone. Glad to be here. Not as glad as Oleg, but glad anyway. And it's a wonderful thing, these weekly meetings. And before we get Andrew on the line, perhaps I was thinking of something crossed my mind. So if Andrew is trying to replicate the biggest trend followers out there, the biggest CTAs out there that are on the SocGen index. And but then I wondered what other trend following methods these funds employ, and I see that Andrew is trying to approach this question from the other way around. He doesn't, I suspect, he doesn't really care what trend following methods they are using, but as I am on the other side of this mirror, I do care what other methods they are using. And then it crossed my mind to ask you, Jerry, what other methods other than breakout that we all do and love, and other methods than breakout that did you research, and I don't know, perhaps what others almost crossed the line of um, getting to a position where you thought that you could employ them or you did employ them? I don't know. That's the question.
Well, I pretty much just stuck with trend following and breakouts. I looked at moving averages and I looked at combining breakouts with moving averages. And anything that I tested or implemented was just a one off or two off of the basic trend. So, like sometimes when people talk about like volatility, correlation management, dynamic positioning or sizing, they start at a very complex level, like level 10. And it's hard. And I'm like, oh, that's nothing like I do. So what I would do is I started with basic trend following, and then I would add some ball management or add some profit taking, and it was still really heavy duty trend with just a little bit of extra stuff around the edges, which I didn't continue or continue to pursue. But uh, the basics was always just the breakouts and diversification. And I think you're right. I think, I'm sure Andrew talks about his partners and talks about the people who run the algorithms and stuff. And so they're really smart people. And I'm sure that's how they figured out how they should attack their problem. And it really is just trying to figure out what those positions are to get close to that return and not really caring. Wouldn't help his cause to try to figure out how they're coming to those positions. I mean, for one thing, it's 20 different traders doing lots of different things. And one would think that, well, that makes it incredibly more complex. But I doubt that that's the case. I think it makes it a bit easier because some people are adding to the British pound and some people are taking British pound off, and some of these positions kind of net out to like zero. And it's probably trying to get to the essence of these 14 positions, how much of each of these 14 positions should we have on, and in which direction. Obviously they've proven that at least in 2022, and since they started, really, that it's something that they can do.
And I want to say about breakouts, my thoughts, and nothing new. But I think that I was thinking about this a little bit. I think it's nothing much even to think here, because on the one side, breakouts have big correlations with moving averages, but I like the idea of Jerry that breakouts works better. And Moritz said that also, that breakouts, it's not a, like Moritz said that it's he wants a pure price, not derivatives of price. And Jerry said that breakouts are so uncomfortable that it's much better, because uncomfortable methods, it's proven that uncomfortable methods are better. I'm talking about my ideas now. So, and Jerry, of course, also said this. And I think that there is no, for me personally, I don't see the sense of diversification between breakouts across breakouts and moving averages. Of course, if you have a lot of very much amount of money on your deposit, maybe it make a little sense. But first of all, we must focus on diversification across the markets, and then diversification across the enters and exits by breakout systems. I think that's. I don't think it's something bad to diversificate across this to take breakouts and moving averages entry points at different times. But I don't think it's bad. I think it's not necessary. I don't see the big sense of it. I only want to add this.
Yes, I agree with all that. I this element that Jerry brings all the time, that it's the hard thing, and I do think there is something here, because indeed, if people find it the hard thing to do, less people will do it. So there is some money on the table right there. And another element that makes me love these breakout models is that they're so consistent. If you look at the maximum price over a day or over a week or over a month, it will remain the maximum price. The same with the low. Whereas where you calculate the moving average, it gets dependent on the window you're looking. I mean, if you're calculating the average of a price, and all you have is the monthly data, it will not be the same if you calculate the average where you have the daily data. So this is another element that makes me favorable to these breakout models. But anyway, I was wondering what other models were out there. So we have the moving averages. Another that we discussed here also was that so-called chandelier exits. I think it's chandelier. I'm not sure. But yeah, it can't deviate much from that, right?
I think that it's part of course, a breakouts and moving averages. Of course, it's a part of our moving averages. Can be a part of our trend following. It's not against our trend following philosophy, but it's, I think, I'm not the best way. Maybe it's very problematic to say what is the best way to, but for me personally, I agree with Jerry. I agree with guys who think that breakouts are the best decision for them personally and for me personally. And I want to say that I like what Niels said, that breakouts are very clean. And this moment is very important for our trend following journey, to do the same things. We all know this, to do the same things in the same situations. And so we must have very clean methodology for enter, for exit, for our position sizing. It's one of the most important things.
Yeah, no, I agree with that, Oleg. And I do think that the breakouts have this huge advantage of being so easy to see and measure and so on and so forth. But I don't think necessarily we can say that one is better than the other. I don't know that we can say that if it feels more uncomfortable, that it is better. I'm sure all types of trend following can feel pretty uncomfortable at times. The other one I would add, Bruno, to your question about sort of traditional trend following strategies being used today would be price series momentum. I think some managers use that. And of course, not to forget that there are two kinds of breakouts. There's price breakouts and there's volatility breakouts, which I think from memory came before the price breakout in terms of being used by traders in the early 70s and 80s. But there aren't that many different ways of doing trend following. And I think if you just follow one of them, and I guess if I was to choose one, I would also choose just breakout. Then you should be in good shape. At the end of the day, it's all about what we do with that process that makes the difference, whether we're going to be successful or not successful.
Yeah, I agree with that. That it's the same thing. Like we all know. Yes, yes. And I'm saying the same thing that you have said. The same, and I said this a few minutes ago. The same thing in the same situation. And whole our philosophy is all around this: to do the same thing, to do the good thing, to do the thing that is proven, that we have a very good back test from which we took, like Jerry said, the minimum that is the main minimum, because not all from the past can be a good guide for the future. So I like breakouts.
Yeah, I think Niels was onto it. You know, it's the process. It's well, the rules are primarily, for making sure you handle all the situations the same way every time. So the key is choose something and stick with it. I do think that the breakouts. I don't know if I've really tested the moving averages as much. If I did, I don't remember it. Some of the research projects we've done, I remember like everything about them, but the moving averages, I don't remember too much. But um, I do think it's really good in the sense that they keep you in the trades longer, which, to some people, that's a negative. I don't want to be kept in this trade any longer. It's crashing. But yeah, so I think that is a bit of an edge. It lets the profits run a bit more. Um, when I was on this Meb Faber podcast with Salem, it just came out, I think, yesterday or the day before. Salem's really funny. He's a really great trader, and he he is a guy, and I said it on the podcast. Salem just has, over the years, he just had more guts than anyone. I mean, that I knew. I mean, these drawdowns just did not bother him. He Not in the sense that it was going to prevent him from doing the trades and continuing to do the next trade. And that's really the key, is that whatever you're doing with your trading and your position sizing and your leverage and your risk, make it to where you could continue to perform the system trades. And he was the best at that, not letting it get to him. One thing that came up, was taking small losses. And I was just thinking when Mev and Sunil were talking about taking small losses, that taking the actual loss is so easy compared to letting the profits run. Um, now, that's just for me, and I think, but I think a lot more money is lost, you know, from not letting profits run, because people have a tendency to want to get out and have rules that don't let profits run. And but the taking of the loss, and especially with the diversification, keeping those losses small, whether you have a specific stop loss for each position or not, that is kind of the key. But I'll tell you one thing that kind of, when I first started trading, I had a very good time. I have had a very hard time putting the trades on. And that was because I didn't want to take a loss. So once I got the trade on, oh, hell yeah, I'd take the loss if it went against me, 2 ATRs in the turtle days. Yeah, sure. I mean, I'm not going to hang around. That's no problem. But just the fear of taking the loss or having a losing trade was so bad for me that it really, hampered my early career, the first 6 months of trading, I was just so timid. And after a few weeks of trading, Rich would call us up and he would say, "Okay, how do you think your trading went last week?" And I said, like, "I don't think it went very well at all." And he goes, "Yeah, you need to do more trades." "How many trades did you do?" I said, "I did like 5." "And how many do you think you should have done?" "Like 25." And he was like, "Yeah, don't let that bother you. Just put the trades on." And so that kind of like mentoring, like he wasn't going to give me the business too much, but that's why, these type 2 eras, missing a trade, you've got nothing in your arsenal to help you if you miss that trade. And so you never can miss that trade. You've got to hit those breakouts. Type 1, putting a trade on where it's doing something that's not going to work. Oh, you've got your stop loss. You've got your methods to keep those losses small. You got those things covered. No big deal whatsoever. But trend following, um, you cannot pay attention to the back test to the degree that your analysis has said, hey, this is what a good trend looks like before it happens. This is a good setup. This has never happened in the markets. We're always being reminded that we're going to see things we've never seen before, and we're going to have setups that are inferior or setups we've never seen before. I don't even know what setup really means, but I hear people talk about it. These excuses as to why you're not going to buy that breakout, and that's the death.
No, I was just going to say, I completely agree with you, Jerry. And it was a great conversation with you and Salem. And I do think that it's harder to stick with the winners because I think people are more likely to want to secure a profit. They kind of know when they have had enough pain, so they will get out at some point. But getting out too early, I think, is a big issue. Now, I want to throw in, if I may, because I may have to leave early before Andrew joins, but I do want to throw in some thoughts after the last week's episode or on your spaces about replication that I've been thinking. And it came to mind when Andrew tweeted something like single manager risk. And it prompted me to reply saying, well, what about single replicator risk? And I think for me, and I know you tried last week to kind of figure out where things might break down in a replicator, which I really don't hope because I think that their success this year may continue unless something goes wrong. But then I think it'll hurt all of us, so to speak, because of all the press that they're getting. But I think for me, if I think about trend following, I think about the diversification of markets and I think about the diversification of models. And that is so important in building that robustness. But when I think about the replicator, the way I understand it, trading once a week, using 10 markets, essentially using one replication methodology, so one model, that is probably where I fear that things could go wrong, that there isn't that diversification that we preach has to be part of it. So if I was going to put sort of one point of concern in this, that's probably where I would say lack of diversification of markets, of models. Yeah. So if I'm not here when he joins, I'd love someone to ask that question.
Well, unfortunately, I've been talking to him on direct messages, and he's not joining because he can't get in. So he is going to figure out what's wrong with his hardware. I guess I don't know. It could be. Yeah, I don't know. I can't speculate. But he's not going to join. So he said he'll be here next week. He said he threw his phone across the room, and my dog fetched it. So he's not happy, but he'll be back, and we'll have many conversations with him. But I wanted to ask you something, Niels, about because this is a really good topic, and it's 14 markets, and um, you can go to his website or copy the link to the spreadsheet, and it's what I do every day. And I think with you, he said that it was 14 fixed markets, and I didn't realize that. I thought it was going to be let's see, 20. Yep. Oh well, yeah, 14 again today. 1.079 billion, and I can see all his positions, longs and shorts, quantities. So, anyways, I thought he was going to choose from like 50, monitor 50 or 60 markets, the essentials, the liquid ones, currencies, commodities, grains, metals, energy, and replicate, take 14 to 20 or whatever the computer says out of the 50 or 60, and then this will be my position, his positions. So, but evidently they're trying to just come up with these 14 markets and just replicate. And he told you, I think, on your podcast that the UCITS product, he has a UCITS product that doesn't allow for commodities. One time he tried to replicate a crude trade with the short treasuries, and that didn't work out. So I think if we get into a grain and he doesn't add the grain market, wheat, corn, and beans, I mean, that's it. That's all you need, right? Just like all you need is the yen and the euro and something else. So I think that could be an issue. What do you think?
Yeah, no, first of all, you're absolutely right. That's exactly how they do it. They don't pick from a big universe. They have a fixed universe, and it's pretty tiny, and that is my concern. So that's one of the things, and the thing about the usage, I guess if they really wanted, they probably could get more commodities in their fund, but I think that the whole point of what they're trying to do is to say, well, if just we get the big trades right, we'll be fine. And and so the other thing I thought about was, well, if we think about when they launched the fund, and I don't really mean this as a criticism, it's an observation. They launched the fund at a time when trend following really started to take off, and where, frankly, trend following has been a lot easier than it was the 5 year prior to 2019. So again, that's kind of, if we look at our positions and the trends, they've been relatively easy. Plus, it's been the big sectors, it's been the currencies, it's been the interest rates that have dominated returns, and so it probably has been relatively easy to replicate. So I worry about the lack of diversification in the methodology. I worry about the lack of market diversification. But I also think we have to take into account that the environment has been good during that live period for trend following, and that matters as well. So yeah, that definitely things to think about when you compare a replicator to underlying managers. And by the way, I know in the spaces you often talk about Paul and his massive returns this year, but of course, those of us who sometimes see the insights as to where those returns come from, you know, all of the returns this year came from one sector. They made more than 100% in short-term interest rates, right? All the other sectors net out. And so, so if you, so if you didn't, I mean, so that just shows you how concentrated returns can be. And if you didn't happen to have that sector, well, you're never going to replicate. Now, I know with the bigger managers, that's probably unlikely to happen, but still, it shows the unpredictable nature of what we do and the fact that we do want to lie and wait for whatever trend, wherever it emerges, and get on it. So I think it's great. And as I've said to Andrew, I think it's fantastic what he's doing because it will get more people exposed to trend following, and we should, or to CTAs or managed futures, whatever we call it, and that's great, and that's really important. Um, but to, but I'm a little bit concerned when managers are being criticized, um, even if it's gentle criticism about our fees, etc., and replication being better. I don't believe in that. It's different, and there's going to be some pros, but there's also going to be some cons, and I don't think we've seen that yet in the relatively short track record. But I really hope, as I said earlier, that it will continue to succeed because the worst thing that could happen for our industry is to see all this press towards a certain managed futures strategy and then it all going pear shaped. I think that would be devastating for our industry.
Yeah, me too. I agree with the sentiments towards him being successful, and I think he will be. And Now, I think I'm in between you and Andrew as it relates to this talking about fees. What's kind of funny before I talk about it, I read the article, couple of articles yesterday, and people are very sensitive about fees. But the articles that I read and I tweeted were this not a new idea, but I guess it's coming back, the pass-through fees. So instead of charging 2% management fee, 2 and 20, they will charge the pass-through and 20 or 30 or whatever their incentive is. And the pass-through basically is all of the expenses our fund generates: salaries, Bloomberg, trips, fancy dinners. We're going to pass those through to the client. We're not just going to keep our expenses under the 2%, management fee. We're going to pass through exactly what we spend. So the article from the Financial Times that I tweeted, two of them, one was from Bloomberg, said it could be between 3 and 10. So 3 to 10 and 20 to 30% management fee, I guess. And the article focused on these famous multi-strategy funds that are hugely successful, and one in particular on Bloomberg that's very successful. And they're closed, and you'll be lucky to get in there. And maybe predicting that some of the clients would say, "Oh gosh, I'll gladly pay 3 and 30. Just let me in," and or 10 and 30 or whatever it is. And of course, some managers deserve that, and some managers are going to get it, and some are going to continue to be successful forever, and some are not. We see these famous hedge funds all of a sudden become less than famous. But once again, this was a critique and a criticism of multi-strategy hedge funds compared to fund of funds. And fund of funds are horrible with their extra layer of fees, but the way that these managers manage all of their traders, hundreds of traders, with this very drastic approach. If you have a drawdown that's too large, you could get fired, and this amazing money management overlay. These guys. So in this midst, I'm finishing up. In the midst of ETF people being very, very concerned about this management fee, is it 95 or 85? Um, you have the other end of the spectrum where you have pass through. Oh my gosh. And then the same person can say, "Oh, I'm going to find a S&P index fund where I only have to pay 4 basis points. I'm not going to pay 5, but I have a handful of pass throughs as well."
A couple of things, Jerry, on that. I mean, first of all, this pass-through thing, I didn't read it, but it doesn't sound like a good idea. I think people should know exactly what they pay, and then it's up to the manager to spend the money the way they want, if they want to travel first class or whether they want to hire an extra researcher. I mean, that should be their choice. But here are some. First of all, I would say, let's just say that for argument's sake, that a normal CTA, let's just say at least sort of how we think about it, we should be able to generate a net return to our clients of somewhere between 10 and 17, 18, 19% over the long run. And so if that's why people would invest with a manager like that, it's really not about whether you're paying 85 or 95 or 125 basis points in fixed fees. It really, in my opinion, then they're focusing on the wrong stuff, because it makes no difference compared to picking the right manager who can actually deliver on that sort of 15% return, not consistently, but over the long term. So that's the first thing I would say. Don't get hung up by 10 basis points or even 50 basis points. Getting the right manager, I think, is much more important. But the other thing I would say is, and this is from what I hear from my sources when I speak to them, and obviously they don't want to go public about it, but a lot of money flowed to big CTAs in the last few years from some of the big US pension funds. And I'm sure they got, at the time, really good fees because the industry was beaten down, performance was pretty flat. So they got probably really good fixed fees, and probably not very much incentive fee, if anything at all. But what I'm hearing now is that with the performance that we've delivered as an industry, these allocations have grown significantly. So now some of these managers are starting to send the money back because they realize that it's not necessarily a good idea to have 50% of their capacity tied up in a flat fee, 50 basis points, with an investor who only pays 50 basis points. And so I teased Andrew a little bit about it. I've seen him tweet about it as well. I would not be surprised if we continue to deliver on what we've seen, that trend following and managed futures can do. Obviously, I'm more focused on trend following. Why couldn't we get to a point where the good firms will basically send back the money that pays the least fees and start charging more fees? It would not surprise me, and I don't think it would be unreasonable. It doesn't mean that I argue for 2 and 20, but I certainly argue for more than 0.5 and 0 for sure.
Yeah,
Uh,
I agree. That's a good point. And however, I don't fully agree. And I'm sort of in between this idea of, it's not practical and possible beforehand for clients to ignore higher fees and only focus on the net fee. Now, I think with a firm like Dunn with 40 years and other firms out there with 40 years, well, 20, 30 years, and this great track record and consistency over time, not every month or year, but over time, it's an easier sell. But the client, they went to business school as well, and they're saying, oh, yeah, I see your point. If I knew I was going to get that net, but and I appreciate your net performance historically, but the odds are that if you're charging higher fees, then that's an odds I can calculate. My net fee, all things being equal, will be higher. But all things are not being equal. I understand that. I just can't predict it. And so I do think that human nature, even if you are 100% right, or people who say just focus on the net, if you're 100% right, um, you're the human nature is going to say, yeah, I get it. And I have made a mistake by not paying higher fees many times before, but still, I'm going to be one of those investors who is going to try to find an equivalent manager and with a lower fee. And it's pure common sense because you can't predict, um,
And you're right, Jerry. I mean, you're absolutely right, and I don't disagree at all with what you're saying. The funny part that I always think about is the fact that when it comes to making the decision about the manager, they do look at the 30 or 40-year worth of track record. But when it comes to the fees, they say, oh, but the future is unknown. And so it's kind of a contradiction in itself. But I agree with you. Emotionally, they think, oh, yeah, but I know that I'm going to save 50 basis points with this manager. No, you don't, because the other manager could be producing 1,000 basis points more return going forward. So at the end of the day, it must come down to, do you believe in the manager? And this is why also I personally, as you know, I struggle a little bit about with replication, because there is no manager behind it. It's a replication. And I worry that going through a period like 2015 to 2019, where we as managers, at least we could look at our models, we could explain to our clients what's going on. A replicator can't do that. They have no story other than, oh, but we're cheaper. And trend following is great. Yeah, trend following that we're producing is great. So that's another kind of
yes.
risk.
So I would disagree a bit on that because the the whole point is that he's replicating the 20 biggest, I don't know if they're the biggest, but the 20 of the biggest CTAs, and that's his sanctuary, that's his comfort. And so if we have a bad period in the markets where we have a bad year and he tracks it, yeah, then the clients are going to say, sure, I don't know what's going on in their portfolios either. And I have I have to have a lot of faith if I owned all 20 of these managers. But for me, it's worth it to pay less And so instead of losing 10, I lost 8 or 9 or 7.5. So I think that as long as underperformance for him though, in good years or bad years, is kind of a bigger problem. But yeah, I don't think, as long as he hugs that index and the replication continues to work, I don't really think he's going to have much of a problem uh, with the performance and with majority of his clients. But constantly, regardless of his performance and the industry's performance, he'll always have replication critics.
Yeah, no, I mean, I hope you're right. And by the way, Andrew is a fantastic storyteller. So if anyone can hold on to investors during a flat period, he's probably the one. So I'm not saying that. All I'm just saying is that I know how hard it can be to hold on to investors, and because we don't want to see them walk away from what we do just before the trends emerge, like it happened in 2015 to 2019. Which is also, by the way, a reason why I think that we haven't seen so much money coming in to the industry from institutional investors, despite what's going on both in traditional investments and in our industry right now, because I think a lot of people made the sort of strategic decision on a board level, saying, "No, no, this is not for me. It doesn't work. It hasn't made money for 5 years, so we're not going to." And by the way, it's probably short-term trading or volatility that's going to protect our portfolios better when we have the next drawdown. So I think that politically it's much harder for them to go back now and say, oh yeah, we were completely wrong, so let's get some trend following. It's almost like we need a new breed, a younger generation of CIOs to make that return to our industry. But for me, it just there's so many memories. Some of them, of course, goes back to when we worked together. Is that it is so difficult when there's no performance. People want stories, and if you don't have something to look inside the box and show people, I think it's a really hard job. But as I said, if anyone can do it, it's probably Andrew, and I hope he will.
You bring up a really good point. He does have good stories, and I love listening to him. He has a great laugh, and he's super smart. And but some of the stories are the same stories because I listen to all of his podcasts and read the articles, but they're still funny, and he really enjoys what he's doing. And you know, we've often said over the years that these clients need to be better educated. We need to educate our clients better. And then recently, though, I've become very skeptical of that. And so and I think he's kind of proving that. So I think, and he loves to say that I'm not a managed futures person. I haven't been around very long, but he kind of knows more about managed futures than most people. And he knows a lot of the history. And he, so in his whole thing is let's wrap a story around it. Like, let's don't educate anyone. Let's talk about the yen and how unusual and crazy that yen was. And so here you have a guy who he is knowledgeable, but he's not coming with it with 25 years of experience in managed futures. So he sounds different. He's got an ETF. He's got a low fee. He's giving people exactly what they want, and performance is good, and it's replicated in an index. People love these indexes, and he is telling these stories, and the rest of managed futures is saying they sound like managed futures. And so I think to some degree, since he doesn't sound like it, and he's having more success.
I agree. And you and I have often talked about the importance of narrative, and we've been kind of searching for a narrative. Clearly, Andrew has found one. But the other firm that's really successful this year and good for them, that also have great narrative and stories, is of course Eric Crittenden and his team, who've also raised hundreds of millions of dollars in their product, again, based on a great story, a great narrative. But at the end of the day, you and we and others, I mean, you would think we have kind of the ultimate story, but maybe we're just not telling it the way people want to hear it. But I do think experience matters, and so I think we should just keep doing what we do, and I think we'll get what is deserved for what Chesapeake and Don and others have delivered for all of these decades. Our story has not become any worse just because other people have seen more flows, but we can learn from what they're doing for sure.
Okay, that's great. All right, I don't want to dominate too much here. It's been I enjoy talking to Niels because we do go back a long way, and we've been doing this for a long time. So, anybody else take over? Bruno, what do you think?
Yeah, I myself am new to this camp too, but definitely not as good a storyteller as Andrew. And I've been wondering if there is a story one can wrap with managed futures. I don't know. I'm rambling here. I'm poor of ideas right now. Sorry.
Hi guys. Yeah, hi everybody. Yeah, so I wish Andrew was here to comment on all the stuff that we were discussing about his fund. So maybe we should probably change subject until he comes so that he can comment. So we're just talking about his fund and him without him being in the room. So I think so. Then we'll have to replicate and repeat our questions when he comes in. But yes, something from the beginning of the spaces, I had a thought about how I just realized. I mean, not just realized, but for me, I find fascinating how intertwined my strategy has been with my life. And I just realized that for the last more than 20 years, I have not been, I have always had positions on against the world, according to my strategy. So basically, and on the few days when I haven't had, or few, maybe couple of weeks when I have made changes or have shift venues or whatever, it felt really, really weird not to have positions. So not to have my strategy express my vision of the world towards the world. And I just realized how significant it is for to have my strategy running. And what Jerry was saying, it's important to stay in the game and just put the trades on and whatever. So for me, for more than 10 or 15 years, the focus has not been on whether a certain market is making me or losing me money or on one day or on a month or a year. The focus and has been on whether I am running my strategy or not. So if that becomes a priority, when the strategy starts to define your attitude towards the world, then you go on this meta level where each individual market or a trade or a performance over a certain period of time loses significance. And I think that level provides the detachment from outcomes, the peace that the long term, the people who are in this business for a long time, they're in that zone where the process matters more than the results. And the process becomes part of your life. And in some sense, I can even say that there's a relationship between me and the strategy and the markets, in the sense that I have learned so much about life and philosophy from the strategy. And then also my life and my relationship with events and people in the world have affected my strategy as well. So there's this symbiotic relationship between me, my mind, and my strategy, where one improves the other. So I don't know what I'm trying to say, but what I'm trying, when Jerry was talking about how difficult whether it's more difficult to take a loss or take a profit or whatever, so I asked myself, oh, how is it with me? Like, what's more difficult? And I just realized I don't even think in those terms. I mean, I'm frankly, like right now, I'm just blindly just following the strategy. I don't even know currently like when I'm long something or short something, or whether I got stopped out or I made money or lost money or crude or short rates or yen or whatever. I don't even care. So yeah, so that was one comment. I don't know if anybody can comment on this.
Yeah, I wanted to comment on that. Absolute. And what really clinched it for me, I've been trying to get my wife to invest with an outside investor that is on this podcast sometimes. Great guy. And she was hesitant. It took me a long time to convince her. I'm not a wealthy person. I'm an average retail guy, but believe wholeheartedly in trend following. And what clinched it for me a few weeks ago, I listened to a 2018 interview with Jerry and the guy I invested with. And it was during a period when trend following was not going good. But you would not know that from the conversation. Their conversation was they believed in this philosophy. They knew the trends were coming. They were talking as if it was 2022 and things were going great. So that I let my wife listen to that, and I said, this is just how I want to live and where I want to put my investments. So I agree, absolutely. It's more about the process. I mean, of course, it's about the results, but the process is what we've chosen.
Of course, I want to say here. Of course, I must say here something because it's very important. All this for me personally, because of course, as I said before, as I said many times, Transform philosophy is one of the greatest philosophies I know. I mean, among the different philosophies, business philosophy and daily life routine philosophy, relationship philosophy, a lot of fields here. And I want to say that, of course, I agree with all that. And of course, I have also listened, and I'm listening almost every day. I'm listening to top traders and systematic investor. I'm doing my notes, re-listening, redoing my notes. Okay, but I want to say that it's very close to my heart. And I want to say that, yes, I have seen that how Jerry Needs and Moritz, in fact, predicted the future. They said, yes, okay, now it's 2000, for example, 2018. It's not much trends. We have a drawdowns, but all the evidence show us that from such periods, we will have a very good periods. And I believe in that because I had my own research, of course, not such great research like guys have, of course not, but not such a lot of samples as. But I had research for a few years. I did research, and I also believed in that. And I understood that it's truth because truth is checkable. I believe that the quality of truth that it's easy to check. For example, I don't know how to check a lot of different theories in trading, macro guys, and so on and so forth. But here it is, I can check, I can look at the charts and see this. And I can see, like Neil said, look at the 50-year chart of any market, and you will see trends in every chart, trending periods. So, of course, as I said today before, Transform teach us a lot of very useful things for us. To be patient, to see the whole picture, to have a good vision, to have a logic. By the way, logic. It's very important because I think logic. Some people have lost logic and imagination. Yes, people have lost imagination, like Neil said. And here we don't need imagination, even in terms of. I mean, we must do the trade, not imagine, but do. It's great. And so, of course, and because of this knowing how our world organized, Jerry, Niels, and Moritz, they had a very good prediction of the future. And as I said, that it's funny fact that macro guys and other predictive guys, they don't predict future. And even if they do predict this future, it's not very useful, in fact. And it's very complex. But traders can predict the future, but not always, of course. And because I mean trend following traders, because they know how this world is organized, this business side, and some also nature, of course, as I'm sure.
I think great point you brought, Absolute, about the trader learning from the system and vice versa. I think this is kind of a platitude. Someone said this before, but that the system is nothing but our brains just better described on an algorithm, on a sequence of rules. And so when you put these algorithms, you kind of reflect on them and learn from them and see what's going on and what's working and what's not. So definitely you learn from that. And connecting to the discussion of Jerry with Niels, I think this is the fundamental reason why this education crusade has been so important for trend followers, for CTAs, because it's not something that's natural to most people, the way we approach the markets. And if you want to make trend following a business, you do need clients. So you have to teach them how this works and how and why this makes sense. And so we were talking about, oh, perhaps we don't need this narrative. We perhaps should try a different one. Yeah, but I'm not sure when everything is all right, performance talks for itself. But when things turn sour, perhaps the clients will fly away too quickly. I'm not sure if they're not as educated or as um, um, uh, as they don't understand the strategy as well as we do. They don't have for a lack of better word, the faith in the strategy as we do have. It's faith is a bad word. It's knowing from the properties of the strategy itself.
Yeah, I think we've talked about trend following being kind of a niche strategy, and I think things can change over time, and regardless of the future, we just have to keep doing what we think is right and handling our trades and our life in a certain way. And then if great things happen, it wasn't so much that we predicted it. It's just that it didn't matter if this was the road to maximizing my wealth or maximizing the size of my business. Um, I'm happy that occurred, or I'm okay if it didn't occur, but it was just every day committing to behave and act in a certain way that you can be proud of when you're all done. Um, I think that one of the keys is for your mental health and for your expectations is have clients that love trend following. I mean, that would be what it would be for me. So if you are always fighting clients and you're always worried about what are they going to think if you have a normal drawdown in a trade or your markets, because the markets, the trend is reversing, maybe temporary or maybe for good for a while, then you're going to have this level of anxiety that plus the anxiety you get from the markets themselves. So I think it's probably just better to go out and find people who understand your strategy, love your strategy. And as I've said before, when I was in my mid 20s and I was in the accounting profession, I read about trend following in a book or a magazine or something, and nothing like the internet today. And I loved it. And I said, this is wonderful. It's great. And the more I read about it and learned on my own, the more I loved it. And then from then on, I loved it more every day. Okay. So that's what I'm saying. Choosing these perfect words and these perfect stories and analogies. And no, I mean, they're fun. I enjoy listening to Andrew. I enjoy listening to lots of podcasts when I'm on the treadmill. That's fun. But No, it's deeper than that, and you just need to find like-minded people. And if that means you're going to have a few 100,000 or a few 100 million under management, then that's fine. It's probably not. It's going to be difficult to have billions and billions under management, and that's okay. However, I do think that as people experience the markets and learn about trend for the first time, or continue to be reminded about how they should invest in trend, things could get a lot better over time. I remember reading about Dimensional Fund Advisors, which is one of the largest money managers in the country, and they had a lot of mutual funds, and I think they pretty much converted them all to ETFs, and it's strictly small cap stock trading. There are a bunch of very smart academic types who done research and written papers about how there is more to be made in small cap stocks. But what makes them interesting is when I first heard about them, they had a very unique process of getting clients. Number one is you could not go to them directly. You had to go through a financial advisor of some sort. And this financial advisor had to go to Texas, I think they're in Texas, and go through this boot camp and learn why the dimensional fund advisor strategy was, how it worked and why it was wonderful, and commit to it. And they weren't going to put up with too many redemptions. And people wanted them even more. And they have billions and billions under management. Um, and I think that is the model. I'm not saying it's going to raise billions and billions. I'm just saying that's the model. Get like-minded people, clients and managers together and see where it goes. See what it, and look, we're in a strategy that's weird and that's trend and it's hard to do and feeds off of human nature and trying to do the opposite of what people like to do, buy low, sell high, etc., predict the markets. And so we're probably not going to have the success of DFA, but that's the way to do it.
And I want to say very important, is very important words Jerry said. I want to say that one of the maybe signs that trend following is a great philosophy for me personally, that I have, for example, a lot of true things, not false things, true friends, true relationships with other people. And a lot of, and it shows that I have true mindset, that it's real mindset, that it's close to its mindset that is according to laws of nature. I think so, because all is true, and all true investors here, like Jerry said, people who love trend following. But with investors, I think there is such a thing that they see, as I said before, and what I mentioned at least, that when the investors and some friends and some people around you, when they see that you are succeeding, they with you. If you are not, they are not with you. They, like Bruno says, they flow away. But what is the direction of their flowing, that investors? It's very interesting because the direction to another successful at that moment manager. And we know that every strategy have a quality, that every strategy have a quality of underperforming. And when that manager is underperforming, they go to another, and at the end of the day, if even they go, theoretically, we can imagine that they go to the best managers in the world, they lose that investors with such ideas, with such a mindset, and a lot of people have this mindset. They lose a lot of money with this. And of course, investors who stick with the system, with the manager who loves, who investigate what we do, of course, they get wealthier because they're consistent. And I have said before that investors like consistency, and they don't see consistency in real terms. They see that consistency. They want money every month, for example, like salary in their jobs. But they are inconsistent guys in the world because they don't stick to a stretch. We have a lot of business, at least. We must stick to what we do. For example, if a sportsman begin as a basketball player, then he began to be a football player, then he began to be a boxer, then another thing, swimmer. Yes, it's okay if he is 10 years old. It's okay to choose, maybe to choose what he really wants. But when the person choose different things, he's inconsistent, or person goes to the different churches of different religions, maybe it's not very good comparison, but I think so. But consistency is very important here, and so that people who are inconsistent, they do not doing a good deal for themselves only. And when you will be, when the trends occur, uh, this person will give you money anyway, the same person, I think. Most of them will return, but it's not good for them. And who is loving, trend following, who understand you, and I think it's maybe not much people will be, but I don't know. And I think, but maybe with a huge amount of money, because it's smart people. They're smart, and maybe they have a successful businesses. For example, I'm talking, yes, long in this my speech, but for example, I saw that a guy in Twitter, a lot of guys, they say they like business coaches. Is another topic maybe. They are business coaches. They teach how. And this one guy said, "I'm a millionaire," and I.
Sorry about that, Oleg. I want to hear from Alp. How you doing, Alp?
Hey Jerry. Hey everyone else. How you doing, guys? It has been a busy week, to be honest, on my end. Now, I'm listening all this conversation. So I was keeping an eye on the model. So this week, the short term trend model that I'm running is this month is positive. So. So just to give you a flavor of what is happening on my space, there are lots of breakouts on the short-term space. So that's positive. And on the modeling side, I've spent a lot of time basically to be able to. Now I use automation to be able to trade. So like Jerry Parker, Morris, and others might be using other traders that are working for themselves. But because I use automation, what happens is I need to use the correct bid and offer, and it's quite a challenge because it is easy to use an average price. It is easy to use the average of a bid and offer to be able to do your back tests, and it is absolutely fine if you're not going to trade from that back test. But because I am trading from that back test, I need to use the correct bid and offer rate, and that, of course, that changes every hour. So, and there are other challenges around, what was the bid and offer rate a day before, or what is now while I'm going to enter into the market, and what is the correct bid and offer rate to be able to exit from the market. And the problem arises if I use a correct bid and offer rate, because then I might enter or exit early and my model doesn't, or my model enters or exits early and I don't. So while the computers are doing the trade execution, there is always this, it doesn't matter whether you are a short-term, medium-term, or a long-term trend trader, there's a complexity around dealing with this bid and offer rates, because market has something else called this touch and go. It touches and then goes to the other direction. So what I'm finding is fascinating, and this is a lot of code to be able to do it, automated in an automated fashion. But I think it is worth it because it just frees a lot of time on one's agenda. So that is what is happening this week. I just wanted to share. Thank you, guys.
Well, we got
Yeah.
to do a shout out to Richard. He didn't make it today. and he told me he wasn't going to be able to make it, but Andrew's back next week, so we'll have Richard to gang up on. Maybe Niels will come back, and Moritz, and we'll all gang up on Andrew.
Jerry, can I comment on the pass-through fees and on the multi-strategy funds?
Of course.
Yeah, I read the article that you tweeted. So over my career, I've been in quite in few of those places, prop desks and multi-strategy funds and how they operate. And I don't think I mean, those are really, really well-run machines and businesses, and I don't think they should be compared to just a single fund fee or a replicator fee or ETF or basis points. And there's a reason why they're closed and why there's lines out the door of investors waiting to get in at those fees. The way they're run, they're really like, if you look at it as a multi-strategy fund or the big ones, famous ones, or at a bank prop desk, you basically, they're running 200 small businesses. They're like venture capital investors in 100 plus 200 small businesses, each called pods. They're teams of traders with their own strategies. So each of those 200 is almost like a fund. It's like a business. So they're overseeing them. They're allocating capital from one to another. They're giving them risk allocations. They're giving them boundaries in which they can move in terms of drawdowns, exposure per sector, per strategy, per factor. So to aggregate all that into one big conglomerate, it's not trivial. It's far from trivial. And this, I would say, this is again where volatility normalization and position sizing, I think, comes from. So if you, let's say you as somebody like you, Jerry, would like to join and be one of those 200, you and your team would want to join. Now the risk guy will have to put you in some context. So you would have to explain to him what your volatility will be in certain timeframes, in certain sectors, in certain allocations, so that he knows, because you're a black box to him. And he cannot afford to the guy in the center who's organizing all this, he cannot afford to have 200 black boxes, because managing the risk on a total level becomes almost impossible. The risk of ruin becomes uncalculable. And so to understand where volatility normalization comes from is in momentum and trend following. If you look at momentum and trend following as just one of the 20 factors or alphas that you want to explore as a multi-strategy fund, you have to volatility normalize all 20, including the momentum and the trend following one. So this is where the pressure comes from. It's not from investors or because they're big or they're trying to be fancy or they try to be rocket scientists. But if you're a multi-strategy fund, if you're this company, it's much better than fund of funds. You have to put all these factors and all these pods and all these small businesses that are running under you into a similar risk management context. And that's where volatility normalization comes from, I think. And so when the biggest multi-strategy funds, so I will not name names, or prop desks at banks, like each running 100 plus or 200 of these small businesses and strategies. Yeah, they may charge pass-through fees and whatever, but if you look at their realized Sharp, these guys have realized Sharp of 3 plus 4, bigger than 3 and 4. So who cares how much net fees you're paying when your net returns has a Sharp of higher than 3 or even 4? So that's why there are lines out the door. And Niels was right to say that who cares how much the fees are? You cannot compare that machinery with somebody who's charging 85 or 95 basis points, because he's not claiming he can deliver Sharp of 3 or sharp of 4, or some annual return to drawdown ratio bigger than 3. So that's my comment.
I agree. And that's why I said the same person could say, I'm really going to find the cheapest. I'm going to be super sensitive on my S&P indexing or my CTAs, but I'm not. But I will do anything to get in with Millennium or Citadel or some of these other large firms. And so I agree. It sounds contradictory. My point was, it's not contradictory. I don't think CTAs though are necessarily, or most of them are in that category. So fees are going to matter a bit more. I'll take Andrew has it easy because he's replicating a group of CTAs who charge 2 and 20 probably, or something close to that. And they would probably all, or any of them would be very acceptable to a lot of high net worth and institutional investors. But I think my point also is every time that you and I put on a trade, it's not random. We are playing probabilities and odds based upon our back test or our experience or whatever. And that's why we're choosing a specific day and time to, for instance, enter a trade or exit a trade. Well, probabilities are the same. If you are looking at two CTAs that kind of look similar, you can't predict the future. One is outperformed different times over the other. I'll go with the one with the cheapest fees possibly. I think that's a rational decision.
Yes, I agree.
By the way, I was very surprised when I saw that fee that people like cheap people with, in fact, with huge amounts of money like cheap fees, and it was fascinating. Or I don't know. I was very curious for me, at least, to see this. Only I want to add only this, but I was surprised when I saw how much they think. Some people think about fees more than about their money, about the risks of their money. I saw a guy with 3 million, a guy from China, 3 million United States dollars. He wanted a few 50 United States dollars on collective, and it was and a guy with 300 United States dollars, 300,000 United States. So he wants also a fee as cheap as possible, only maybe 50. And in collective, when he asked me in my collective account, may I? Can you do a discount for me? I don't want to pay 50 United States dollars this month. Can you do a discount for me? Can you? May I not pay anything this month? And I was surprised such things. Yes, it's surprising. I'm not talking that it's bad or it's good, but it's surprising for me.
So, guys, 2020 was a great year, at least some parts of it for trend followers, and then 2021 was a little slow, perhaps. This year is a great year. So I wonder what's going to happen next year. Are we just continue to ride on the fact that the interest rates are going up and then down, possibly, or somewhat there is going to be some fluctuation in the interest rates, in the inflation. I mean, it seems that the things are just going to be good for some time to go. So it's a very favorable market for trend followers and people who are running their businesses with this sort of a strategy. I think there's a lot of optimism out there and a lot of hope to be expecting some good returns over the coming years. I'm not quite sure what you're thinking, but I feel when I look into this global macro trends and the central banks and the countries, and I'm in UK, I'm looking into the more than 10% inflation rate. I'm saying, yeah, I'm glad to be running a trend following strategy. So that makes me very hopeful and positive about life, to be honest. Just wanted to share. Thanks.
Yeah, I'm not in the habit of really thinking too far ahead, but I should be. I like that idea. What's going to happen next year? Yeah, hard to say. This year, next year, the end of this year. It's very interesting. It's very interesting watching a lot of counter trend activity, sometimes in the dollar and interest rates, um, stocks. Yeah, it's all very interesting to anticipate. And I'm really happy I don't have to think too much about it. As far as trading goes, I like thinking about it just over a glass of wine.
So in terms of that counter trend activity, so for instance, this month is very positive for the short-term traders. And I was looking into my benchmark long-term model, and it is slightly down. So there's always benefit, I believe, in this time frame diversification. And there are years, 2015 to 2019, there are years where the long-term models were a little bit more flat, and the short-term models could have done a little bit more money there as well. So, and this is one of those months that what I'm doing is positive, whereas if my long-term benchmark model is any sign, so the long-term model is a little bit flat to negative, something else like that. So for next year, with this high volatility going on, with the inflation, with the rates, we don't know what is going to happen. But I'm pretty sure that we are, in terms of our macro understanding, it is we are not going to go back to low interest rates, low inflation, where buy and hold and S&P just goes up, and people just do make money with low skills and low downside protection. So this thing in mind, I think there's lots of hope. I'm expecting trend following in to be very successful, not only this year, but hopefully to continue like that, as long as this macro uncertainty continues. But I might be wrong, of course. No predictions, but that's what I'm hoping for. Thank you.
One of the things that I'm trying to do with my own strategy is trade stocks and trade a lot of stocks, trade enough to where it's going to matter. And I do sort of a spin on what Niels mentioned with Standpoint and Eric, that instead of being long stock indices all the time with half your portfolio or something like that, just a standing long position in stock indexes. I am going to trend follow individual stocks in the same way that I would currencies, commodities, and bonds. So I want to hopefully not get into a situation where if stocks rally, and a lot of stocks are in big uptrends, and then a lot of stocks are in big downtrends, and the indexes in the U.S. are kind of hanging there. But there's a lot of other stuff going on. So I want to increase the chances that my trend following is going to be successful through thick and thin, and through a period where the only trends or the bigger trends are in equities. And I think one of the things that I've sort of said, and I guess I'll try to bring it up with Andrew next week, is the difference between trend following and managed futures. So managed futures is a different beast, and is perfectly happy trading indexes and being a crisis alpha, a component of a traditional portfolio, quote unquote, whereas I'm trend following the world and I'm creating the perfect portfolio. You're not going to have the perfect portfolio without trend following, without trend, stop losses, and without massive diversification. And so you've got to have enough stocks in there to where it makes sense, not to satisfy a marketing urge from clients but to where it makes sense mathematically. I know that's what Eric has done, but just doing it a different way. And that's what I want to do, doing it a different way than he's doing it with the carrying the trend following philosophy all around the world to as many markets as possible, especially stocks, especially the markets that people care about the most. And yeah, so this is, I don't know why I said all that, but I think something prompted me to.
You know, I totally agree. Now we are going through this bear market, right? Where the major stock indices across the globe are going down, and it would be just wise, it would be just trend following. I would say it would be just right to ensure that when this bear market finishes, we need to write this thing up as much as any other long only guy or any other, buy and hold investor. They are all waiting for this thing, right? Everyone else is just praying and waiting and hoping that this pain is going to over, and they are all going to go back into those nice days, and to be able to get there, and we will get there eventually. So this bear market is going to be over, but when this thing over, we need to be getting the benefit out of it too. So that's absolutely necessary that we construct our portfolios, as Jerry said, in a way that can take advantage of these single equity instruments, and trade them in a diversified fashion. So when things are going up, when these long only investors are making money, we must be on that boat too, guys. This is definitely what I think. Thank you.
Hi, Jerry. Yeah, I have a question, and I think I may have asked you this question before, but I don't think I remember the answer, or at least I don't know the answer. How do you, given that there are, I don't know, 10,000 stocks in America, 50,000 stocks in the world, how do you deal with selection bias as to which 100 to trade out of these 10,000 or 50,000 that you deem to be giving you what you want, in the sense, yeah, you want to have exposure to equity markets, and these are the 100 right ones, and out of all possible sets of 100 stocks out of the 10,000, would all sets satisfy your goal, like give you the performance that you need and give you exposure to outliers? And so, because we're all systematic traders, and I myself am very careful and sensitive about which parts of my system and process are systematic and which are discretionary. And my goal has been to minimize the discretionary decisions about the whole process, whether it's a market selection, whether it's sizing. Oh, now I'm losing money and now I'm going to cut size. Why? Because I feel scared. So to me, that's a discretionary decision that's based on emotion, and I like to minimize that. So my question is, are you concerned about the discretionary aspect of choosing 100 markets out of a universe of 10,000 when you choose the stocks to trade?
Beautiful, beautiful. Man, I was taking notes because that is some good stuff. Now, this leads back into trend following. I was going to say 101, but it's a graduate course in trend following, which is not managed futures. Okay. And it's trend for it's not many people doing the trend following things. Okay. So, as you know, I have bits and pieces of this I've said many, many times over the years, but I'm going to put it all together. So, I don't pay attention to the back test as it relates to choosing the markets. I look at the back test after I've chosen them and see how it's going. And at one point, I've said this, where 4 or 5 years ago, I made some radical changes to the single stock part of the portfolio. I got rid of a lot of older more liquid stocks and introduce some less liquid, but still very liquid stocks into the portfolio. Some had only been around for a few years, let's say. I need about a year's worth of data to fit into my system. But and my backtest people, my research people came to me and said, this group is no good. Our backtest is dropped with this group of stocks that you've chosen. Now, and of course, I was like, it doesn't matter. If I'm not going to choose any of the markets, currencies, commodities, stocks, bonds, based upon the backtest. And in fact, it's kind of sad, but how do CTAs choose the markets they trade? Whatever the futures exchanges give them, that's the markets we trade. Now, some people trade 65 or 70, so they're more interested in the more liquid ones. And then you start talking about adding single stocks, they get paralyzed. Oh my God, no one is telling me here's 100 to trade or 50 stocks or whatever. How many? No, you've got to figure it out on your own. And they can't do it. They won't do it. Although, as I said before, I was listening to a podcast a few months ago and from a fairly large CTA who trades in the managed futures program, indices only, because that's what CTAs are supposed to do, because they're futures. And there's 25. I don't have to do much research. But they traded 5,000 stocks in other programs or whatever. Okay, so I'm choosing the stocks based upon diversification and liquidity. I'm going to do some minor diversification analysis, but not using a back test per se, but I'll do it in another way. So I'm going to come up with a fairly good diversified liquid group of stocks. And my universe is going to be fixed. So when I fix that universe, I'm sort of saying I need to just trade this group of markets because I don't want to keep adding and subtracting markets because I'm going to lose 10 times in a row on Amazon or IBM. But on that 11th time, it has to still be in the portfolio. So I get the big outlier. So that's old school trend following, fixed universe. There's no such thing as the 100 right ones. And to some degree, it doesn't really matter apart from this diversification and liquidity factor. You're just doing the best you can. You are caring a bit about smoothness and not being overweighted in any one sector. But at the core of systematic classical trend following is all the trades have the same expectation. So they all are going to have you're taking away from this back test because you're treating all the markets the same with the same systems and same parameters, and you're treating the longs and the shorts the same, to where the average trade historically is going to be what you expect in the future, and what you expect out of each market is sort of what you got in that back test on average for all of the markets. So you'll miss some and you'll get lucky with some, but stick with that fixed universe. And of course, you can't do that because, as Andrew likes to say, pork bellies, well, they don't exist anymore. And then some of the stocks go out of existence and they get bought up or go bankrupt or whatever. So, but in adding, to replace is fine. But my goal is to have this fixed portfolio, rely upon the numbers, believe that my expectation per trade is the same in every single market. And so it doesn't really matter too much performance wise, profit wise, which ones I choose. But I am going to try initially to set up my portfolio I desire more diversification rather than less because there's no trade off as it relates to potential profit.
That's
So
right. And because all the trades have the same expectation, that's what we think, that's what we see in the numbers, and we think that expectation, and we see in the numbers that the expectation is positive. We need to be doing all the trades, and we should therefore do a lot of them on a lot of markets. And that would be another, reason why the 14 markets that I can see in Andrew's portfolio, for me, just wouldn't be enough. I'd like to increase the attack vector and do more of these trades, get into more of these positive expectancy trades in independent markets, not just 14s, of which half are interest rates. That's just, for me, has to be better. I don't know, a couple of days, maybe yesterday or the day before, I don't know, I got short coffee, I think. And coffee isn't in Andrew's portfolio. So maybe coffee is going to be a big outlier trade. I don't know. It does have the same, or I'm allowing coffee to have the same contribution to risk and returns as every other market in the portfolio. But I think it's important for coffee to live in the portfolio. And I don't see that in Andrew's system. So let's see where that goes. But you have to do all these trades and find these different markets in order to have a better experience, I think, with the program. I just love trading them all. They're all slightly different. Some of them similar, some of them different. But you have to trade them all, I think.
Well, before I get Absolute to comment on my answer, I wanted to, because you took us back to Andrew, which is good, because that's a really good place to go. And I proposed, and Niels didn't, I don't know if Niels asked him this. Yeah, he kind of asked him this question towards the end of the podcast, and Niels did not get an answer. Andrew avoided the commodity question, coffee, and I brought up grains. And he also avoided the question that I brought up, which is that, well, I don't know if Niels actually brought it up this way. This is what I would say, though, is that ironically, it's easier to replicate these 20 without coffee because I guess they're pretty large and they may not have enough of a, they not be able to give coffee the same weighting that Moritz and I can. But also they vol manage and correlation manage. So on something like the yen, well, Andrew has said, yeah, I'm not even short British pound or gilts. Yeah, it doesn't really matter so much because those 20 managers that he's replicating, they cut those markets off at the knees with their volatility and correlation management to reduce the position size to where they look more like the 10-year. And so he's having an easier time of getting away with these 14 markets because they're not maximizing the outlier. Neil said today that, well, a lot of the profit has come from a lot of managers who've crushed it this year from overweighting short-term interest rates. Yeah, because the ATR was like 3 when you put it on. You went short the euro at like euro dollar at 5, and it's now 25. Well, they would never allow that outlier to occur. Andrew doesn't even have to worry about it so much because managed futures CTAs, those 20, they want to get rid of that crazy outlier. They don't want coffee to be overly profitable because that means overly volatile. Moritz, what do you think?
Yeah, I think you're correct, Jerry. And I jumped in front of Moritz. I didn't see he was responding. Well, the biggest 20 CTAs are Andrew wants to track the biggest 20 CTAs. The biggest 20 CTAs have no choice because of their size than to make most of their money from the biggest moves in the sectors, like the main moves in every sector. There's the 4 sectors. So if you're a $5 or $10 billion fund, you have no choice but to count on catching the outliers on the sectors themselves. You cannot count on pork belly or orange juice outliers. Orange juice outlier means nothing. Even if he trades however Jerry trades, the amount of size that he can put on will be nothing, will be 1 hour volatility on his fund. It will be nothing because all his other positions are orders of magnitude bigger. So in that sense, to answer Jerry and Moritz, yes, Andrew cannot capture orange juice or coffee maybe or smaller market outliers or some small stock, Russell 3000 stock outlier, stock with a, I don't know, $50 million market cap with low volume that Jerry can capture as an outlier, which because it sees a smaller fund that he trades a lot of stocks. But these big funds, they have no choice. They have no choice. So their performance for the month and for the year has to be 99% driven by the fact whether there is an outlier, whether there is a trend in one of the four sectors or not, period. And that's what Andrew's argument is.
Exactly. And when you think about it, he could do it with fewer markets. He could do it with four. He could have four ETFs, a stock index, a commodity ETF, a bond ETF, and a currency ETF. That's probably all he would even need, just four of those. In order to get the profits from those sectors. It's the sector moves that he cares about. Of course, he would not be replicating an index, which is another kind of game. Clients love indexes. They love to pay low fees and have the indexes replicated, this advisor network, and they put these things in your portfolio. Yeah, that sort of thing too. So he would not want to do that, but over time, probably replicating what Andrew does with four ETFs, which are going to represent that sector and essentially give you more diversification with inside of each ETF could be hundreds or 20 to 50 markets. But yeah, it's really fascinating. But grade me on my answer to the question about choosing 100 stocks.
Yes. So my question is, since you said you don't care about the performance, so you said your team came back to you with backtest and says, hey, these stocks, 100 stocks are whatever, the backtest is not stellar. So out of the almost infinite number of sets of 100 stocks, because if you have 10,000, you can almost have infinite number of permutations of 100 stocks to pick from the 10,000. So you have some limitations. It has to be from different sectors. You have to be diversified. So you do have some seemingly non-discretionary but quantitative criteria for choosing or picking. But my question is, so let's say you pick, according to your criteria, 100 stocks. And for one reason or another, you run a backtest on those 100 stocks over the last 20 years, and their performance is abysmal with your strategy. Let's say they're treading water or even losing money overall. So they're down over 20 years. Would you include them in the portfolio?
Well, I don't think that's going to be very likely to be the case, but I will concoct a scenario as to how I think it is the case. I don't think they could be worse than the indexes for sure, and the indexes test out okay, pretty well because there's been these big bull markets. But I do think that another thing that I would look at, and I've said this many times, and so has Richard, is that I would tilt it to where I would not be in favor of choosing stocks that looked like an index. Like I wouldn't want to go long. This is going to really blow your mind, but I wouldn't really want to go long Berkshire because there's too many businesses in there going on at the same time. It's not going to give me that outlier of a sweet spot of a company that's 5 to 20 billion in market cap that has maybe one or two profit centers, and if we get a supply crunch, and it can just take off because it's in a commodity based or something that's going to in short supply or yeah. So I would not be in favor of those, but I've tested a lot of single stocks before, and in performance with the group is about the same. I've randomly chosen from thousands of stocks 100 at a time, and performance is about the same as it is with choosing the commodities. I don't think like a long-term system would have an expectation. I'm not going to give you 100% accurate numbers, but let's say it's like 3 ATRs. So the average trade is 3 ATRs. And so I don't think that it would be any different from stocks versus commodities or bonds or currencies. However, over long periods of time, commodities, for instance, would recently it had like negative expectation, but over the entire 30, 40-year test period, each of the sectors would also come in at about that same 3 ATR expectation.
Okay, that answers the question, and that's then you're fully within your right to just pick any. If basically you can pick 50 or 100 sets of 100 stocks out of 10,000 or from whatever universe, and you still get similar expectations and statistics, that not only proves the robustness of your method, because you're constantly getting confirmation from out of sample data, but it also allows you for diversification and minimizes to zero the risk of selection bias. So yeah, that's a very, very good answer. Thanks, Jerry.
Yeah, and it reminds me also that Richard reminded me when I first met him that the big benefit of trading 100 markets versus 50 or 200 versus 100 or 300 versus 200 is the bet size gets smaller and smaller. So to counter what I said, it would be, well, why trade 300 or 200? Why not just trade the 65 that Niels talks about? Because the expectation is the same. And over time, the performance will kind of win out. It'll be similar over time. And it's this, and in Richard's response to that was something like small bets. I like to take these small bets. It's my ultimate risk control. My stop can get blown, the market can blow through my stop, but I have a small bet on. Like I was short Amazon this week, so that's good for me. But I've also been long and short stocks that have gapped massively against me. I was long Netflix back in the summer or the spring when it had that massive sell-off. So, but one thing I wanted to ask you is that comment on, I don't really agree that almost regardless of how you choose your stocks, if you don't do it the way I did it, versus how you choose your futures. I think to some degree, it's probably about the same amount of discretion. You were throwing around discretion. How do you minimize this discretion? And this is the big problem you see is like, oh, you utilize this discretion in choosing your equities. But I was trying to make fun of the way CTAs choose the futures markets, because that's kind of discretion too, in the sense that I'll choose the ones that the CME gives me. It's a joke.
Yeah, no, absolutely. That's not discretion, and that's what I would use. And you minimize discretion when the rules of your system overall, whether it's for selection of markets or whatever, are purely systematically driven. So a market gets included because of X or Y. So maybe some people can only trade 65 out of 100 futures markets because the cutoff is 65, because the 66 to the 100 don't have enough liquidity, period. But so the system, purely systematic system, the way I understand it, was get all of the universe, tradable universe for that system, and then the system systematically excludes or includes markets in it. So a proper CTA system would include all 100 markets, but then you would say, hey, if I'm above 3 billion, then I'm excluding markets 80 to 100, because this average size will not, when I try to put let's say my average size is 10% of the daily volume. So that's a rigid threshold for exclusion and inclusion of a trade and a market in your portfolio. It's not discretionary. So yes, the most robust statistically robust system would, one, include the widest universe tradable for that system. Two, have selection which is systematic. And three, have that selection be as simple as possible, not complex, because the more if-then rules, of course, if you have in your system, the less statistically robust it becomes. So so this is where the science becomes art in our systematic trading. A lot of people think, oh, he's just systematic, he just follows rules, just the computer trades it. No, there's a lot of potential ways that you can fit in discretion or fit in complexity, unnecessary complexity in the system that will lower its statistical robustness. So this is where experience comes in, where the 30, 40 years matter. Obviously, people with 30, 40-year track record have answered these questions correctly. People with a 30, 40-year backtest may have not. That's the distinguishment between real record and backtest.
I'll need to think about that, but initially I still don't see that if you just come in and trade all the futures, that the ones that have been created by other people, how that's like, I guess it's not exercising your discretion, but I really don't sort of see how it's any better than just randomly choosing 100 stocks. And I think as long as you trade them, whatever market you choose, as long as you continue to have that fixed universe, it doesn't really matter how they were chosen. But I do agree that you should trade as many as possible. And if you get too large, you won't be able to.
No, but Jerry, you answered your question satisfactorily when you listen. The situation would be different. Let's say out of a billion possible sets of 100 stocks, out of a 10,000 stock universe. So let's say, I don't know, I can't do back of the envelope permutation calculation, but let's say there's billion possible sets of 100 stocks out of 10,000 stocks that you can trade. And let's say half of them lost money and half of them made money. Okay? If you randomly pick a set of 100, then you are actually exposing yourself to the risk of just randomly picking a successful set of 100 stocks and putting into your portfolio. Whether you will stick with it for 10 years or not, it's irrelevant. But because you told me from the samples that you've done, let's say you've done 50 or 100, and most of them are showing similar performance, hopefully positive performance, then the odds of you actually benefiting from a lucky pick of 100 stocks diminish to almost zero. So this was what I want to try to clarify. This is why your answer to the question, oh, what if those 100 stocks have bad results? And you don't care, because most of the sets of 100 stocks that you've looked at show similar results that you're happy with. That's good enough.
One thing I found running my back tests is that different systems, I'm talking about simple systems, simple breakout systems with one exit, one entry, and one stop loss. Different systems have similar trade statistics, that similar hit rate, similar average return, similar win to loss ratio, and I find that they present these similar statistics even when I compare the system applied to different sectors. So this goes in line with what Jerry just told us, that if you apply a trend following system to whatever you have in front of you, you have a pretty high level of confidence that it will have that around 40% winning trades. You have around 3 ATR win for every 1 ATR loss. It's about the same. The thing that comes to my mind is that then we have to pay attention to risk of ruin, in a way that we want to avoid taking simultaneously trades that will hit their stop at the same time or about the same time, and potentially wipe us out. If you were trading, I don't know, 100 markets, and each market represent 1% of your portfolio, what you cannot allow your system to do is to hit the stop for all of them at the same time. So one way to avoid that, just like Jerry just said about the comment on Richard, you reduce the size of your trading. Another way to do that is by selecting markets that you have a hint that will behave differently. And I think that when Jerry says that he looks for companies that do not behave like an index, that will have one business going there inside that is independent, that is different from everything else, on a completely discretionary basis here, different from, I don't know, from your perspective of the world, the way you understand that business to run. I don't know, a company that sells eggs. It's an example that was brought along at some time. That also reduced the risk of that company going sour, of that stock going sour at the same time of others. Yeah, I would say that now coming closer to an answer to your provocation, absolute. I would say that a systematic way to approach this is to find some way to inform the system that it must select return streams that will not hit the stop at the same time.
Yeah, that would be entering the correlation discussion that I don't think you can count on that. I think I love how Jerry's situation. I love Jerry's solution for the risk of ruin. And I have to say I haven't considered that before I came to these spaces. So I've learned a lot from here. But so I like the Richard's and Jerry's separation of closed equity, closed trade equity, and open trade equity. So there's two types of dollars in their portfolio. One type of dollar is the one type of dollar, which is closed trade dollar, which they guard religiously. And another type of dollar is type 2 dollar, which is open trade dollar, which they apply loose pants method, and they allow it to fluctuate and have much bigger drawdowns and losses, as long as they protect the closed trade equity with their rigid stop losses. They're allowing to play loose pants strategy with the house money, with the open trade money. And this is how they protect from risk of ruin. Because why? Because if all trades, so the size is decided as such, and I don't want to give out Jerry's whatever parameters or numbers. If all 100, let's say they trade 100 market portfolios, if all markets entered and they all hit their stop loss, which means they nibbled on the type 1 dollars, on the closed equity dollars, and they all got stopped out, they would still be, and they all got stopped out, there would still be a big chunk of the portfolio left. They will not ruin them. They will not ruin them. So let's say they'll be down 40% or 20%. So on the closed equity dollars, they don't care what that percent is on the total, including the open equity dollars. So to protect, to take into account risk of ruin, is to religiously watch closed equity dollars with stop losses which are religiously followed. And even if they all 100 enter at the same time, now it doesn't have to be at the same time, but if all 100 markets are in and they all came out of that trade, not through a profitable exit, but through a stop loss, rigid stop loss that eats out closed equity dollars, then even at the most unlucky scenario, they will still be around to put a next trade. They will not be taken out of business. Whereas with the open equity dollars, open equity, they can go to drawdowns 50, 60%. They can lose it. I mean, of course, not all, because they have trailing stops, but they are much less religious and paranoid about quote unquote losing open equity dollars. And this is the beautiful distinction that I really appreciate.
Hello, Jerry. Can you hear me?
Yes, Michael. Good morning. How are you?
Hi, I came in late. Had some work to do. Sorry. A few things. First of all, selection bias is misunderstood. Bias can be good or bad. It depends on the underlying premises. Now, take a universe of stocks that you think they have good liquidity, apply your system, make a random sampling distribution, and if the mean return is sufficient and the t-statistics is good, then you are not sampling from a distribution of zero mean. And I think that's what you meant. If you agree, I have a question for you after that about some practical aspect of the business.
Yes. Go ahead.
Yes, let's say you run a fund, CTA managed future business of 100 million, and suddenly some big fund comes and they add 100 million to you. Do you wait for new signals to add to positions, or you add to already existing positions?
Well, I think the way to do that is you have to put the positions on if it's in a fund, so as not to dilute all of the older investors. If it's a managed account, I think you would have to talk to the client about that, and then. But I would encourage the client to put in 10 million at a time or 20 million every month and go slowly, so I could go ahead and put all the positions on, even in the managed account. But I think it's a difficult thing to do, and it's a big risk, because when you go and invest in funds, you need to understand their strategy. And my strategy is to let profits run and to have big open trades that can fluctuate wildly while I'm protecting that closed trade equity, just in the exact way that Absolute said. And so you have to understand the risk that you're getting into. There's traders out there that are up 65, 70% for the year. And if they end the year plus 40, that's great. But it's going to be a big drawdown for clients who are just getting in. So you need to make sure the client understands all of that.
Yes, to answer that question, I have always adjusted to size. So whether it's investors or allocators of capital, they give you money, they subtract money, the markets are liquid. And the difference between me and Jerry is that I look at all dollars the same. All of my dollars are type 1 dollars. And that's the difference between me and Jerry and classical trend followers. And this is where volatility adjustment comes in play. That allows you to treat all dollars equally, and dollars coming in and dollars coming out, they can just go in and out and have the same statistical exposure going forward, which is confirmed by the statistics of the strategy. So yes, if I get tripled or quadrupled in size, tomorrow morning I just multiply all my positions by 4. It's easy.
Yeah, what about if it's at top of the market, like DBMF AUM grew to 1 billion at the top of the market? Do they keep this in cash?
No. If there was a way to, if there was some autocorrelation in the series of your strategy, then you should be able to take advantage of it. So in my strategy, there's no positive or negative correlation. So there's if I've had a 100% year, the next year is equally likely to be the average performance versus if I had a down 30% year. So to say whether something is a top, to predict the top, first of all, that's not the trend following ethos at all. And second, because I'm volatility adjusting, the drawdowns on all my dollars, okay? So if you compare the drawdowns on all dollars between me and system like Jerry, my drawdowns will be smaller per average annual return, per CAGR. And I've tested this with all sorts of ways. So I will repeat. I understand Jerry and Richard's division in type 1 and type 2 dollars, and I love it. And it's really nonlinear and it's beautiful. But if we compare overall performance, if they treated all their dollars equally, like I do, which is how I do it for investors, for whoever's adding or subtracting capital from my strategy. If we treat all dollars the same, the CAGR, the average annual return I can achieve per unit of drawdown is bigger. I will achieve bigger, and maybe I'm running the test wrongly. Maybe I'm doing something wrong, but my conclusion is, and which is why volatility adjusts.
This is referring to, right? This is absolutely, this is the moderator, right?
Yeah, some call it MAR rate. Yes, I wasn't sure what MAR is, but I think that's what MAR is. It's annual return versus max drawdown.
Yeah, just one quick commentary here. When you're treating these dollars differently, as Absolute puts it, it's not as straightforward as doubling your positions if you're doubling the capital of the fund, because you have to figure out how much of that extra capital is proportional to the closed equity and what's proportional to the open equity. But anyway, it's just one step further.
No, but that's the problem. That's why, Bruno, that's why Jerry doesn't have a direct answer as to what he does with new capital. Like whether he waits for only new trades or he puts it all in immediately. So he has to pick something in the middle because of this concern. Because if he puts if he doubles everything, then as Jerry said, if these guys who are now 60, 70% up, they end the year up 30%, but the client who got in the top, he's in a 30% drawdown or whatever. It's not 30, but 25. Yeah, he's in a 30% drawdown. So,
yeah, you should ideally you should explain to that investor that, okay, look, I don't know, 40% of what you're putting in, I see it as open profits, so that can vanish.
Exactly. 40% of all your type 1 money for me is type 2 money.
Yeah.
Okay, what I don't see.
Say, are you sure you want to put it all? Wouldn't you prefer to put a smaller amount? I don't know. That's I think that's where conversation comes in.
Maybe Jerry can answer this, but what I don't see when I see managed futures reports, I see the master account. I don't see the performance and the dispersion of individual contributions. And my impression is there is a huge dispersion there. So any comments on that?
Oh, I don't think I understood your question, but if it was something like, by looking at the statement, you can't see the distinction between open and closed, I agree with that. You kind of have to keep it yourself. But I think Richard and I have done ourselves a disservice in being transparent about how we calculate our trade level, in the sense that if we just talked about this magic algorithm that we had written that allows us to make more money, let profits run, and reduces materially, better than anyone else, our risk of ruin, and we can't tell you how we did it, we'd probably get a lot more respect than sort of going on record with this goofy idea of two separate or three separate equity curves. And I think, oh yeah, I wanted to tie this back into something Absolute was saying about these multi-strat firms. Like, I can't work for a multi-strat firm because I'm not being a good contributor to this three Sharpe ratio because I'm having these crazy drawdowns. I'd last like one afternoon letting profits run and trying to convince them that, oh, but I have my closed trade equity and I'm really defending that. And so I think they'd say, yeah, what are you doing? That's crazy. Looking at anything other than today's equity, the equity right now. That's how we do it. And we're keeping a tight rein on this thing. So what it all boils down to is, well, maybe not all, but one of the primary commandments of trend following, the 10 commandments of trend following, is do all the system trades the same way every time. Well, if I'm going to pay attention to my total equity, and that is my trade level, and I'm going to be very conscious about that, then I can't do all my trades because some of my trades are going to be money management trades, not part of the core system, because I got to scale back. I need to trade smaller sometimes because the markets are crashing, and I have sized my positions based on yesterday's AUM. So because we say, no, I don't want to do that because that's getting into, I'm not fully, faithfully executing the system the same way all the time. Then that's why we default to another way of trading a scaled down version of trade level, this closed trade equity, so it allows us to do those trades and not have a separate category of trades, which is money management trades, risk management trades.
Okay, Jerry, I will try to rephrase. Every manager has started with an amount and grew that over time. And you say the annualized return is like 8%, 10%. But along the way, there were contributions of customers. If you take the performance of each customer and you make a distribution, what would that mean be? How this distribution would look like? Will it have an annualized return mean like 8%, 7%, or there would be like a Pareto distribution and some people lost money, other people made money? This is my question, because what we see always is some long performance that started with an amount and grew.
Oh yeah, good question. I'm sure it would be less than the return that the fund received throughout that entire history, because people have a tendency to buy at the top and get out at the bottom. And I wanted to make a comment going back onto Bruno's comments about spreading out the entries. Yep, that's the key right there, is you want to spread out those entries. So that's where the diversification is very important, even for money management schemes like mine and Richard's, is that because we're focusing a great deal on the closed trade equity and preserving that and defending that, but we are taking losses, and 60% of the trades are losses. So we need to be very careful, and with our diversification and trading too many markets that are all hitting up on the same day or within the same week. Now, I think that probably could be said about the interest rate markets, that we probably did put those trades on in close proximity to each other. And that gets totally washed away as a problem because, hey, they turn into big profits. But nonetheless, it still is a problem.
Jerry, Can I comment on what you said, that you and Richard may have been too transparent about closed and open equity? And I think I also commented to you on our exchanges. I would actually go the opposite way. I think that providing in your prospectus information or your closed equity curve will actually give much more peace to your investors, because the closed equity curve will not have the drawdowns that you are so notorious about, and all the CTAs, they don't know what they're doing, they have huge ups and huge downs. But the way to explain this to people is that, yes, we are hunting outliers, and in order to hunt outliers, we have to tie our capital in two types, type 1 and type 2. Your type 1 capital, which is closed equity, right? Here's the equity curve of how that's growing. A little drawdown, and then flat, nothing, and then when the big trades get taken out, you get all those profits, huge jumps in profits, and then again a plateau. So stepwise plateau, step plateau, where all the profitable trades are taking profits without much drawdown, because that equity curve will not show the drawdown on a big trade that made money. So the closed equity curve will only show the 6 ATR profit. It won't show that it came after a peak at 12 ATR and a 6 ATR move down. So 6 ATR drawdown. The 6 ATR drawdown from plus 12 ATR will not show in the closed equity curve. It will only be the stepwise upward 6 ATR when the profit was taken, and those dollars turned from type 2 open equity dollars, got moved into the closed equity bucket. And I think I have not seen this, but if I was a CTA advertising and I wanted to attract capital, and I was doing this separation in type 1 and type 2 dollars, I would present them the type 1 equity curve. And I think it will provide them the context, the philosophical context, to focus on what you focus. And it will align their incentives and philosophy with yours. This is my opinion.
I agree. And I love that idea. I think it can go far with some people, not too far with others. Another thing too is, historically, every single day of the back test, the open trade equity is greater than the closed trade drawdown. So every single day, except the first 6 months or so, let's say, once you start building up the open trade, you could withdraw your money and never have a drawdown in your your realized profit and losses. So I think it's just the way that trend following needs to work, and it should work, and it's a beautiful thing, and it's just a complete package. I think initially it takes a long time, or a bit of a time, for really smart people to appreciate it. It doesn't mean that they ever agree or change the way they do things, but I have seen a couple times where people did kind of go, aha, I see what you're doing now. It is beautiful. But most people have clients, or they are clients, and they live in the real world, and they do have the human need to watch the account very closely and feel really bad when there's an open trade drawdown, and they don't like that. They don't want you to do the hard thing, do the right thing, follow your system. The largest CTAs have billions of dollars under management, and they don't do this, and for good reason, because they know the clients really don't like it, and they just try to figure out a way to have a trend product, CTA managed futures product, that can gather a lot of assets. And this heavy-handed, what I call heavy-handed money management, risk management overlay is, everybody wants it. The managers want it, and the clients want it, and it's just crazies like Jerry talking bad about it. But it is just one of those things where you have to be satisfied to have a smaller business and just a small group of clients, in my opinion. But I definitely don't think that if most of those CTAs, the large ones, if they had no clients, or if their clients gave them the go-ahead to do it the way I do it, they still would not choose to do it that way. They're in agreement with their clients that you should pay attention to Sharpe, you should pay attention to the total trade, the total assets, and manage that very intensely, plus the trend following thing as well.
Yes, I agree. That's what I'm doing, and I'm not doing it because of the clients. I'm doing it for myself.
That's right. It would have been interesting to be in the turtle program with people who had come in with a lot of investing knowledge and been taught in a traditional way, and to see how they would have pushed back, because it's very easy for almost all of the turtles and for all of original trend followers, old time trend followers, to start with just trend following and fully accept with open arms trend following plus a lot of money management and overlay. But I'm in the big minority on that. But it would have been interesting to see what would have happened in the pushback that they would have had, because Rich and Bill were super smart. I mean, incredibly smart guys. And Bill is just an amazing genius when it comes to math and stuff. But he kind of didn't let that get in his way of doing the classic trend following.
I think this is very interesting. I could almost predict, if I saw the person's background, education or career, I could probably predict whether they're going to vol manage or not. And I also fall into that category. I mean, I come from technical mathematical background, but also it depends on how you see the world. And in terms of most trend followers have come into trend following and they were lucky. They either had a mentor or whatever to teach them the right things. But some people who have not had mentors in their career or investing with markets and have dabbled with different things. They're good with computers, good with data, they're testing this, testing that, and learning about statistical robustness and whatever. And then there are these few rules of thumb that you kind of agree to apply that have been, just like trend followers have them, cut your losses short and let the profits run. For a statistical guy who has analyzed oodles of market data for all sorts of searching for all sorts of alpha, spread trading, carry trading, like there's different ways of extracting money from the markets. There are certain things that you have to apply on all of them as a meta rule to allow you to merge them into a consistent strategy and view of the world. And volatility adjustment is one of them. So this is the difference. So in some way, a lot of the quants, they research and go through phases and they do overfitting, and the strategies work and they don't work and whatever. Then they start to realize robustness. And then the way I see it, I've interviewed a lot of people, to hire, and I've been interviewed by a lot of people. There's almost like a trajectory. Like in a 20-year career, the first 10 years you add complexity, you throw everything in the kitchen sink to the wall and see what sticks, and you try different things. And then the second 10 years you take things out. So as you become wiser, you start taking things out. And for most people on these journeys, what remains are just the very few robust sources of alpha in the world, which at the same time are showing themselves robust. When you learn about complexity, about robustness, about how many if-then statements you can have for how much data and whatever. So there are a few things that remain, and those people inevitably have some momentum and trend following in their strategies. And those people have no other way of trading it except with volatility adjustment, because that's what they have known all their lives as they've tested different other strategies. So there's two different backgrounds of momentum trend following traders. One ones are the ones who have not traversed this mountain of complexity and then down towards robustness. One is they have done this, traverse to complexity, and then the other one is the lucky ones that they didn't have to. They just lucked out to have a mentor like Jerry to sit next to him or next to Richard or some of the turtles and whatever. They lucked out with the gold, and then they just stuck with it. And they don't necessarily have to volatility adjust because they didn't have to. They didn't have to research all the other sources and other sources of alpha and other factors. So this is how I understand it.
Yeah, that's the reason why me and Oleg are so much grateful for every week talking to you guys.
The most difficult periods of trend following are not the sideways markets, are the strong trends, because people have this urge to pocket the money. And I know this because I started many years ago trading currency futures, trend following. And I've seen some people I knew trend followers this year, they have lost their discipline. And it's the good times in trend following that caused most of the pain. This is my experience. I don't know what Jerry has to say.
Yeah, I think you're right about the choppy periods. And I was very grateful that AQR and others came out with papers after during that period where the CTAs had tremendous underperformance for 5 or 10 years, and saying that, hey, look, the only thing that's changed is we didn't have those big trends. Well, we didn't. We may have had some big trends in stocks, but the CTA managed futures is not usually trading single stocks and not putting themselves in a situation to profit from outliers in stocks. But I agree. You get into these situations where you make so much money and the profits are so large that it can be a little destabilizing. And I try to stay away from the markets and not even look at my performance or look at the markets too much when things are going too well. And then holding on to these profits, it's just something that becomes your bottom line. You know, I want to book these profits. I have plans. I have clients, and it's going to distract you from. It's rare not to be distracted from the size of the profits, as relates to being disciplined and carrying through, regardless. You know, who among us is willing to let a large profit turn into a small profit or a small loss? Well, the back test, the computer was, and the computer said, don't worry. You'll be fine overall. But once again, I'm not concerned about overall. I'm concerned about right now.
Jerry, so I forgot actually wanted to comment on those equity curves, and I also mentioned in our exchange. How I would do a prospectus for your strategy, I would have we divided the dollars in type 1 and type 2. I would have a type 1 equity curve, so closed equity curve, that will be at the bottom. So that will be like the ones that's at the bottom. On the top, I would have total equity curve, type 1 plus type 2, which means closed plus open equity. And that one will show all the drawdowns, but all the drawdowns will be above the closed equity, above the plateau, stepwise. And in the middle, in between those two equity curves, I would have type 1, so closed equity, plus the equity curve of captured type 2 dollars. And what do I mean by that? As your trailing stop moves above the first stop loss, as it moves into positive territory. So as the trailing stop moves into positive, which means this trade is now profitable, but even if it got stopped out, it will still show profit. So I would call this third equity curve. This is third type capital, which means type 2 capital, which is captured. So not totally open. So you can have a drawdown, but up to this point. So that point at which you would capture that profit, I would almost put that into closed equity, because you're almost certain, if there's no gaps or whatever, you're almost certain to move that capital from type 2 into type 1, because that trade is now profitable. So even if it has a drawdown of 4 or 5 ATR, once it gets out, it will show a 3 ATR profit. So I would put those 3 ATR into closed capital, and that will be the third equity curve, which will wiggle between the between the first one, the second one, and this will be the third one. So type 1, closed equity capital, closed plus open equity curve, and in the middle, closed plus captured open. And these 3 equity curves, when you put them in a prospectus, will do, I think, a lot to educate your clients into what to expect, not to focus on the open equity and on the big drawdowns, for which our industry is so notorious, because people who don't understand it, they all look at the open equity curve and say, oh, look, these guys don't know what they're doing, they'll go bust. But these 3 equity curves will show you that no, you will not go bust, that your risk of ruin is fully controlled. And then the smoothness of the other 2 equity curves will convince them that they should stick around. This is my argument.
I love that. That's a great idea. Many years ago, we had our administrator and accounting team put together a closed trade equity performance table. And so that would be another way to show clients, like, here is the closed trade P&L. And it's just like you say, in very good months, we would probably have a negative return, because we're letting those open trade profits run. They're not to be considered, but we probably took a few losses. And then in very bad months, the bad months are probably going to be generated by the retracement of open trade profits. We'd have very good months in the closed trade equity performance table. And to some degree, it reminds me a bit of a private equity performance table.
Exactly.
We're not.
You don't mark to market, you just go when it's done, when you exit.
And as you say, we don't have that luxury that they have. We don't have the people in Congress lobbying like, oh, never mind. And so we show both, and we say, okay, here's what it looks like traditionally. Here's the pain you're feeling with drawdowns, but pretend that you're like with your private equity. Here is what, and we're actually we're actually using real P&L, real valid actual trades from an exchange to calculate our closed trade equity, which would be something, even a closed trade. Well, I guess it would work the same way with private equity, but yeah, it would be really interesting to put it in those terms. But the industry is 99% something else. So Richard, Jerry, Mulvaney, so few, even low profile classic trend followers.
Why not using a maximum adverse excursion?
I'm going to have to look that up. The one thing I got to say is I need to go and I'm playing my first game ever of pickleball. So if anybody has any suggestions or advice on pickleball, DM me. So I'm not looking forward to it, but anyways.
Hey, Jerry.
Yeah.
This is Ribby Run. I just have a quick question.
Yeah, go ahead.
Okay, thanks. And this, sorry if it's a little off topic, but does anybody out there or yourself utilize portfoliovisualizer.com? And if so, is there an ability to do some back testing on there that is not necessarily a relative strength based back test? And if anybody out there knows what I'm talking about, please DM me. I'm at Ribby Run. Thanks.
Yes, it's a good platform, but keep in mind their data is in monthly time frame. You won't see daily drawdowns over there. So the drawdown will be understated.
Okay, yeah, I mean, I've got some models built in there based around relative strength, and so I'm familiar with the the monthly illustrations or backtest results, and it does provide you a forward-looking screen, if you will. So is that what we're talking about?
Well, I personally do not trust any platform I haven't built myself or haven't explored in detail myself. I don't know what assumptions they use, but the monthly data will understate risk significantly.
Right. Okay, that's good to know. So lastly, just if anybody out there um, is good using that portfolio visualizer, I would welcome a DM from you. Okay, I got to run. Bye.
Okay. It's been fun, guys. And it's been a long one and a good one. And we made it without Richard. Wow. And without Andrew. So next week, I bet you we have Andrew. And we'll come with our questions and talk a long time about replication and how wonderful and what a great job he's done this year. So with that said, everybody, have a good weekend, and I'll see you next week. Bye now.
Thanks, Jerry. Goodbye. Bye, everyone.